As a FERS employee, you have been blessed with an incredible retirement system. With the TSP, your pension, and Social Security, you are set up for retirement more than the majority of people in the private sector. So please count your blessings. But the one downside for having an incredible retirement package is that you will be subject to more taxes than other people might be in retirement unless you do something about it today. One huge myth, one huge misconception that I see and hear all the time from FERS employees is that in retirement that they will be in a lower tax bracket than they are during their career. And for some FERS, this is absolutely true. But for many FERS, this is not the case. Because if you do not want to lower your standard of living in retirement, you will often be using the same amount of money. And if you are taking all this money out of the regular TSP, your Social Security, and your pension, the majority of that is taxable. So I'm going to go through each of these three benefits, your TSP, your pension, and your Social Security, and discuss why and how they are taxed. So hopefully you can plan for it now. So I'm going to start with Social Security. So this is one big one that most people do not realize can count as taxable income. And how it works is once your combined income, which is not combined, let's say with your spouse, but combined with a number of different types of income is what they define it as. It gets pretty complicated, but I'm going to try to simplify it as best I can for you here. So once your combined income is over certain limits, which I have in my article that is associated with this podcast or video, once those limits are broken by your income, then up to 85% of the benefits you receive from Social Security will be included in your taxable income for that year. And when it comes to your Social Security benefits, there's nothing you can really do to stop this taxation other than trying to get your income under those limits as best you know how. Now, when it comes to your TSP, there can be a vast difference in how that money is taxed in retirement by which type of TSP you use during your career. So you might already know, but the two types of TSPs are the normal or the traditional TSP and the Roth TSP. And the main and big difference between these types of accounts is how they are taxed. So for the traditional TSP, let's say you put in $100 into that account. You can take that as a tax deduction for that year. So let's say for easy numbers, you made $10,000 in this year and you put $100 in your TSP. You would only be taxed as if you only had made $9,900. So that's tax deductible. But when you want to take that money out in retirement, let's say that $100 that you put in, let's say it grew to $300, right? It tripled, which is very common. Then in retirement, when you pull that money out, that money will be completely taxable. Now, if we compare that to a Roth TSP, where when you contribute to your Roth TSP during your career, that money is completely taxable. Where if you made $10,000 and you put $100 in your Roth TSP, you would have been taxed as if you made the full $10,000 in that year. But when that money grows in your Roth TSP, when you try to take it out in retirement, it is completely tax-free. So let's say you put in $100, it grows to $300, you could take the entire $300 out without a single cent of taxes. So a huge planning strategy that many people use and is extremely effective is by investing heavily in their Roth TSP so that in retirement, they can pull out of there. It's not going to bump them up into higher tax brackets and make their Social Security taxable income. So this could be a huge advantage, but it has to work for your situation. For some people, it doesn't make sense. They'd rather have the tax deduction today when they're making the income. So you have to look at your situation and see what makes sense for you to lower your taxable income now and down the road. Now, when it comes to your pension, during your career, you might have noticed on your pay stubs that a small amount of your pay every pay period goes towards the retirement system or your pension. But at the end of your career, when you're finally going to be taking your pension, only a small amount that you're going to be receiving, only a small amount of that you actually contributed. So basically, for most FERS employees, about 95 to 98% of your pension that you get every month in retirement will be taxable income. And there's nothing you can do to change that taxability other than trying to keep your total taxable bracket as low as possible. And like I said, one of the best ways to do that is through your Roth TSP and making sure that that money can come out tax-free in retirement, and therefore lessening the tax burden on every one of your other benefits. And it is important to note that we really don't know where taxes are going to go. We don't know if taxes are going to be higher in the future, lower, or what politics is going to do. We just have to prepare ourselves as best we can now for the future by saving as much as we can, by investing in ourselves as much as we can, by doing the very best we can to set ourselves up for success in the future in retirement, so that when surprises come up, because they will come up, that you have some wiggle room in your plans, that you're not so tied down to decisions you made years ago. If you, let's say, didn't save enough or other things, that you have options to say, hey, taxes are a little higher in retirement, but I saved extra, so I'll be fine. Or, hey, taxes are a little higher in retirement, but I saved a lot in the Roth TSP, so I'll be fine. So make sure you look at your situation and say, hey, what can I do now to make sure my tax situation in retirement won't be as bad as it probably would be if you do not do anything at this point. So please take action now. Whatever it is for you, educate yourself and do the very best that you can do for your situation. And again, if you have any questions, comments, I'd love to see them in the comments below, and I will see you next week.